If you own silver, trade silver, or depend on the financial system holding together in 2026, what's buried in that document matters more than anything you saw this week. Most people believe silver has a price. What they're really looking at is a belief system. The number on your screen is not the price of silver as a material. It's the price of confidence. Confidence that paper contracts represent real metal. Confidence that warehouses hold what they claim. Confidence that supply can move freely across borders when needed. That confidence is weakening. For years, the silver market has been quietly running a structural deficit. More silver is consumed than produced. The gap hasn't caused panic because it's been filled by above-ground inventories. ETFs, vaults, government stockpiles, and private holdings slowly drained to keep the system appearing balanced. No explosion, no collapse, just pressure. And pressure builds silently. Silver demand is no longer optional or cyclical. It's embedded in the modern economy. Solar panels require it. EVs require it. Grid upgrades require it. Medical technology requires it. Defense systems require it. Every push toward electrification tightens demand further, and none of those sectors are slowing down. On the supply side, silver has this problem few investors truly understand. Most silver is mined as a byproduct. That means higher silver prices don't automatically produce more silver. You don't get instant supply response. You get delays measured in years. Permits, infrastructure, financing, logistics. So the market is already tight, already fragile. Now, layer in geopolitics. The world is no longer operating as one unified marketplace. Supply chains are becoming political tools. Resources are being reclassified from commodities to strategic inputs. Friends get priority. Rivals pay more or get nothing. Silver is crossing that line right now. And here's the dangerous part. The pricing system hasn't caught up. Futures markets still assume global fungibility, that an ounce is an ounce everywhere. But real-world trade doesn't work that way when access, security, and delivery risk matter. That's when cracks form. Retail premiums widen. Wholesale spreads diverge. Certain regions quietly pay far more than others. The screen price stays calm, while the physical market starts speaking a different language. This is how systems fail, not with headlines. With mismatches between paper confidence and physical reality. And once that mismatch grows large enough, price doesn't adjust smoothly. It snaps. That's the problem the silver market is walking into, whether people are paying attention or not. Here's what makes this moment dangerous, and why almost nobody sees it coming. What just surfaced is not a headline event. It's not a market crash. It's not even widely discussed. It is a technical disclosure, the kind that slips past public attention, but immediately lands on the desks of people who think in terms of supply control, not price charts. Late last week, a revised mineral assessment quietly went public. No announcement, no media coverage, just an upload. 80-plus pages of geological language designed to be ignored, and that's exactly why it matters. Because buried inside that report is a paragraph that reframes silver's future. Not because it promises cheap supply, but because it concentrates future supply in a place where access is uncertain, expensive, and political. A place that forces decision makers to think in terms of leverage instead of abundance. This isn't about a mine opening next year. It's about who gets to decide later, and markets don't wait for shovels in the ground. They react the moment future control shifts. Here's the uncomfortable part. The data inside that report wasn't new. Sampling occurred months earlier. The conclusions were drawn long before winter, yet the public release happens now, during renewed geopolitical tension, renewed strategic language, renewed attention on Greenland as something more than empty ice. That timing matters, because when information is delayed and released into a charged environment, it doesn't inform, it signals, and signals change behavior quietly at first. While most people are still watching futures charts, something else has been happening beneath the surface. Physical silver has been behaving differently. Premiums aren't just rising, they're diverging. Certain regions are paying far more than others. Delivery terms are stretching. Dealers aren't eager to part with inventory. That doesn't happen in a relaxed market. It happens when participants sense future friction, when access risk starts to outweigh price sensitivity. And this is where the Greenland angle becomes critical. Because when a potential future supply source appears in a region that requires massive infrastructure, political alignment, and long-term security, it doesn't calm markets. It introduces a new variable, control. Control over ports, control over exports, control over who gets priority and who waits. Once silver enters that conversation, it stops trading like a simple commodity. It starts behaving like something strategic. And when that shift begins, the price you see on your screen is always the last thing to change. That's what makes this moment so dangerous and so easy to miss. Late Friday afternoon is when important things are buried. Markets are thin. Attention is gone. Newsrooms are already thinking about Monday. That's when documents get uploaded quietly. not to inform the public, but to satisfy procedure. And that's exactly when this one appeared. An updated mineral assessment, 89 pages long, charts, tables, sampling methods, footnotes, geological language so dry it repels curiosity. The kind of report almost nobody reads from start to finish. Almost nobody. Because buried near the middle is the paragraph that changes how silver should be understood going forward. The revised analysis focuses on a deposit in far northern Greenland, close to the Arctic Circle, a region most people associate with ice, isolation, and emptiness. But the update wasn't about location. It was about concentration. Advanced testing revealed silver grades far beyond what earlier surveys detected. Not incremental, not marginal. The estimate, roughly 2 billion troy ounces of in-ground silver. That number matters more than it sounds like it should. Global silver mine production last year didn't reach 1 billion ounces, meaning a single deposit, if real, if accessible, if controlled, represents multiple years of global supply sitting in one place. Not spread across continents, not diversified, concentrated. And concentration is where strategy begins. Now zoom out for a moment. This wasn't discovered last week. Sampling occurred months earlier, from summer through early fall. The conclusions were drawn well before winter. Yet the report goes public in mid-January. During renewed geopolitical pressure, renewed strategic language, renewed focus on Greenland as something more than ice and autonomy debates, that delay matters, because markets don't react to discovery, they react to disclosure. And delayed disclosure in a tense environment isn't neutral. It functions as a signal. While the public was distracted, insiders were already thinking through the implications. Not, how fast can this be mined? But who controls it? Because this is not a normal mining project. They get built when governments decide future access matters more than short-term returns. That's where silver stops being a commodity and starts becoming leverage. At the same time this report surfaced, something else was happening, quietly, in the physical market. Retail investors noticed premiums creeping higher. Government-minted coins weren't cheap. Generic rounds weren't cheap. Inventory looked thinner than it should have. Delivery times stretched. Dealers weren't competing on price, and they were protecting stock. That's the surface signal. Below that, wholesale behavior started changing. Contacts involved in Arctic logistics, people who supply remote northern operations in Canada, Alaska, and polar corridors, began hearing physical silver quotes that didn't resemble futures prices at all. Numbers north of $130 per ounce. One mentioned around $137 for delivered metal into certain regions. That gap matters. When silver trades at radically different prices depending on geography, access, and delivery risk, the idea of one global price breaks down. You no longer have a commodity market. You have regional pricing. And regional pricing is the enemy of paper markets, because futures contracts rely on a shared belief that metal can be delivered if demanded. Once enough participants doubt that, or believe delivery will cost far more than the screen implies, confidence erodes, and confidence is what holds leveraged systems together. Now add geopolitics. Silver demand was already outpacing supply. Inventories were already being drained. Industrial usage was already climbing. Then a massive future supply source appears, not in a neutral jurisdiction, but in a location that demands political alignment to function. That doesn't calm markets. It forces competition. If Washington secures influence, it protects domestic industries and gains leverage over rivals. If Beijing secures influence, it reduces internal vulnerability and shifts pressure outward. If neither side gains full control, uncertainty dominates. And uncertainty fuels hoarding. In every scenario, strategic buyers act early. They don't wait for confirmation. They don't wait for mining permits. They don't wait for headlines. They secure options. They lock contracts. They build buffers. And when strategic buyers move, they don't announce it. They drain availability quietly. This is how tight markets become brittle. The public still sees a futures chart that looks orderly. Analysts still debate targets. Commentators still argue fundamentals. Meanwhile, physical metal moves through slower, more expensive channels, priced by risk, not optimism. That's why premiums matter. Premiums aren't noise. They're the market speaking honestly. They tell you where supply is stressed, where delivery is uncertain, where confidence is thinning. And when a future supply source becomes a geopolitical bargaining chip, stress doesn't disappear. It intensifies. Because no one wants to be the party without metal when rules change. That's the real story unfolding beneath the Greenland headlines. Not a mining boom, not a supply glut, but a quiet shift in how silver is perceived, from abundant commodity to strategic input. And once that shift takes hold, price discovery stops being smooth. It becomes political. It becomes regional. It becomes volatile. Markets don't break when everyone panics. They break when enough people stop trusting that paper promises can turn into metal, everywhere, at the same price, on demand. That's the story Greenland just injected into the silver market. And it's only beginning. Here's the realization most people miss until it's too late. A massive silver discovery does not automatically mean lower prices. That assumption only works in a world where supply is neutral, accessible, and politically irrelevant. That world no longer exists. What Greenland represents is not abundance, it's control. When future supply is concentrated in a single location that requires political alignment, infrastructure funding, and long-term security, the market doesn't relax. It tightens. Because the question shifts from how much silver exists to who decides who gets it. And that single shift changes everything. The Greenland deposit doesn't flood the market tomorrow. It doesn't even guarantee production this decade. But it immediately alters strategic behavior. Governments don't wait for certainty. Industrial buyers don't wait for mines. They act on potential leverage. That's why this matters now. The silver market was already stretched. Years of deficits quietly drained inventories. Industrial demand kept rising. Supply responses lagged. The system held together because confidence held together. Greenland puts that confidence under stress because now future supply is no longer just a function of geology. It's a function of diplomacy, ports, power, runways, export permissions, security agreements. Every one of those becomes a gate, and gates mean friction. Friction means premiums. That's why we're already seeing signs of regional repricing. Delivered silver clearing at radically different levels depending on location isn't a coincidence. It's the market rehearsing a new reality, one where access matters more than spot quotes. When physical silver trades at 130 plus in certain regions, while screens show something far lower, the implication is clear. The paper price is lagging reality. And here's the psychological impact that accelerates everything. Once participants believe silver is worth more somewhere else, behavior changes everywhere. Buyers stop waiting, sellers hesitate. Dealers widen spreads to protect inventory. Futures traders get whipsawed as physical demand refuses to obey the chart. This is how fragmentation begins. One price becomes many. One market becomes zones. One assumption, global fungibility, quietly dies. And when that happens, the futures market doesn't vanish. It just loses authority. Exchanges respond predictably. Margins rise. Delivery rules tighten. Cash settlement becomes encouraged, not because it's fair, but because physical stress exposes leverage. And leverage systems protect themselves first. We've seen this movie before. Oil didn't become volatile because people needed more energy. It became volatile when supply turned political. Rare earths didn't spike because demand exploded overnight. They spiked because export control concentrated power. Silver now fits that pattern, not because of panic, but because of planning. The Greenland deposit is a reminder that silver isn't just an investment metal. It's a strategic input for electrification, technology, healthcare, and defense. When future access to that input becomes uncertain, rational actors build buffers. They stockpile. They secure contracts. They pay premiums. And that behavior doesn't lower prices. It raises the real ones. This is why the idea that more silver was found, so prices should fall, completely misses the point. The discovery didn't add certainty. It added stakes, and markets always charge more when stakes rise. The real reveal is this. Silver is transitioning from a price-driven market to a control-driven market, and control-driven markets don't reprice smoothly. They overshoot. They fragment. They shock participants who were still watching the wrong number. Greenland didn't solve the silver problem. It exposed it. Now this is where I want to hear from you, because how you think about this matters. Silver isn't just an investment anymore. It's becoming a supply chain decision. And that means different people will see this moment very differently. So here's the first question. If Greenland's resources become a geopolitical bargaining chip, who do you think ultimately gains more influence? Washington, Beijing, or does Greenland successfully play both sides for as long as possible? Drop your take in the comments and explain your reasoning, because that single outcome reshapes the silver market for years. Second question, and be honest with yourself. If silver pricing continues to fragment by region, would you rather hold physical metal you control or paper exposure that depends on delivery confidence? There's no right answer here, but there is an informed one. And if you're on the ground right now, your input is especially valuable. Have you noticed higher premiums where you live, longer delivery times, certain products disappearing faster than others? Share what you're seeing. These real-world signals often tell the story long before charts do. Also, if you're doing well in any area of life, financially, professionally, personally, post a quick win. Not to brag, but to remind people watching that progress is still happening even in uncertain times. If this analysis helped you see the market more clearly, the simplest way to support the channel is to subscribe. We focus on understanding why markets move, not just reacting after they do. Stay sharp. Let's keep the conversation real. Let's bring this full circle, because the Greenland story isn't just about a deposit. It's about how silver behaves when confidence fractures. Remember the opening. A single quiet report uploaded while the world was distracted. 2 billion ounces of silver sitting in one of the most remote, politically sensitive regions on Earth. At first glance, it looks like just a number, but the real story isn't the ounces. It's control, access, and leverage. That's what drives the markets that actually matter. The pattern repeats. Futures prices pretend the world is orderly. Physical premiums tell the truth. Delivery times stretch. Dealers widen spreads. Regions start pricing differently. Paper markets look calm while real-world scarcity quietly grows. That's the crack in the system, and Greenland just widened it. Now look at the big picture. Industrial demand keeps rising, mine supply remains constrained, and strategic buyers, governments, manufacturers, defense industries, don't wait for confirmation. They act early, hoard, lock contracts, and tighten real-world availability. So here's the loop you need to remember. Paper price, real price. Supply stress, screen signal, control commodity. Everything we've discussed, the deficit, the Arctic deposit, premiums, politics, points to the same conclusion. The market is already fracturing, and it's only going to get more obvious in the weeks and months ahead. Keep watching. Look at delivery, premiums, and headlines. The moment the next move comes, one to be when you see it on a chart. It'll be when control and scarcity speak louder than numbers ever could.